What's going on, YouTube? In this video, we're going to talk about Deere and Company, ticker symbol DE. Year to date, this company is down 9.4%. Over the course of 1 year, it's up 15.7%. So, John Deere manufactures and distributes various equipment worldwide. The company operates through 4 segments: production, precision, agriculture, small agriculture, turf, construction and forestry, and financial services as well. The production and precision agriculture segment provides mid-sized tractors, combines, cotton pickers, strippers, sugarcane harvesters, all kinds of heavy machinery. We just did a video on Caterpillar. It's a very similar company. Obviously, John Deere is a very well-known company. It's got a pretty big following. It's got a pretty big name for itself, especially for all the farmers out there. So we're going to look through these financials here. What we're going to do is we're going to look at our revenue, our gross profit to our net income here on this chart. So we can see our revenue is growing. We've got our gross profit also growing, and our net income, which we can see better over here, is also growing with our revenue. Not as quick of a rate as the revenue, but it is still trending higher, which is good. So our gross margin, man, our gross margin sitting at 30-35%. It's starting to run up too, which is pretty nice. Our net margin, again, same thing, starting to head up in the right direction. It's above 15%. It's my number. Revenue versus gross, revenue and gross year-over-year change. We can see we're headed in the right direction. Year-over-year growth, including the net income, all three are heading in the correct direction. Great. Return on invested capital, fantastic. We're almost at our 15% that I like to see. 15% on return on invested capital, 15% on net margin are two biggies for me. Cash to debt is identical to Caterpillar, which I'll drop a link to that video right now. Cash to debt is the same as Caterpillar. I mean, they're sitting on like 7.8 or 7 to 8 billion dollars in cash, but they've got like 75 to 80 billion dollars in debt. So very identical balance sheet over here. Our net income to free cash flow. Here's our net income at 10 billion, and our free cash flow sitting at 2.8 billion. Would like to see that this gap close a little bit like it did over here. Obviously, it seems like they're very inconsistent from net income to free cash flow. So something to keep an eye on for sure. Free cash flow, we can see, is just by itself. It's just kind of all over the board. There's no real good consistency to it at all. Our share count dilution is nice, is trending down nicely. Always good to see. Those that invest for the dividends, they're just continue to increase their dividend payout, which is always good. That means they can afford it, they're making more money. Capital expenditures, this comes off of our net income. Our net income minus capex equals our free cash flow plus a few other operating activities as well in there. But we can see our capital expenditures are starting to increase as well, so something to watch. We want to keep an eye on that. But overall, everything else looks really good. There's a few things to keep an eye on, but relatively minor things. Just, basically we want to make sure to see if they can't close this gap a little bit and make sure these capital expenditures don't get out of control, and their debt is starting to trend higher. So maybe a third thing to keep an eye on. So basically just the debt, the capex. If we can get those two things to not just grow exponentially, I mean, I'm okay with debt, but we want to make sure it's not going to get out of control, because you don't want too much debt and then not enough cash. Just something, for me, that's what I like to pay attention to. I'm okay with debt, but I just don't want too much debt if I'm going to invest into a company. We have some comparisons. We have 4 other companies to compare to. We have TTC, GN or CNHI, AGCO, and CAT. So we've already done a comparison between CAT and John Deere here that we're doing now, but I threw it in there just to have it as a reference. We got 2 red flags over here. We have return on invested capital. Again, 15% or more is my number. We have operating cash flow, which should not be red. So operating cash flow is actually fine. It is, if the operating cash flow is higher than our net income, that to me is something to look into. We want to know why our operating cash flow is higher than our net income. However, in this instance, that is not true. So for some reason that turned red, and that's not supposed to be red. Our market cap, we can see again, this video on Caterpillar that we did just yesterday, go check that out. We have our revenues are not really in the same ballpark, but they're close. And then our market cap are close. Our revenues are very close. Revs, gross profit, income. We can see here's our revenue, here's our gross profit, here's our net income. So Caterpillar and John Deere on this chart, John Deere is just ever so slightly better on terms of its gross profit and net income. Our 5-year growth rate, this is based on analyst expectations. Caterpillar, John Deere also are the biggest growers on the revenue side of things, or sorry, the earnings EPS side of things. However, TTC is overall the best on revenue growth. Here's our gross margin. Solid gross margin is the leader. Operating margin, same thing, very good. Profit margin, very good. Free cash flow, would like to see this be a lot better and a lot more consistent. That was that's something too to keep an eye on. Is just making sure that they can stabilize that free cash flow. Return on invested capital, not too bad. Would like to see it a little bit higher. And then our PE, and compared to everybody else, looks like Toro here is the most overpriced of the bunch, and with DE being relatively fairly valued based on these other 4 companies here. Calculator, Peter Lynch valuation. Peter Lynch gives us a fair value of $558.33. Multiples comparison with all the 4 peers that we just looked at gives us a price tag of $463.64. Our manual PE we have on this company is 25.5 years before this company can earn its current market cap, right? So how this works is you take your market cap and then you minus your cash, you add back in your debt. And then what you do is you take that number between these three and divide it by your cash from operations. So it'll take, 25.5 years before this company can earn its market cap basically plus its debt. Something to keep an eye on too. Like I said, that debt was starting to get a little bit too high, especially compared to how Caterpillar runs its business as well. Obviously, it's 2 separate businesses, but they still produce similar products, right? So, but it is overvalued based on that. Price to book sitting at, right in line with our 5-year average. Our PEG ratio here, our forward-looking PEG is really overvalued. Our current PEG very overvalued as well. Graham's valuation gives us a $751.48 per share. Over here at the discounted cash flow valuation, we have 10% growth rate, discount rate of 6.51. Analysts gave this a growth rate of 10%. We can see our average growth rate is just not consistent. We already know that, but we can also see that even better here. It is just negative, more negative, better negative, positive, positive, going the wrong way again. So this is a little bit of a concern. We want to see continuously growing free cash flow, not very inconsistent cash flow, especially on such a mature company like John Deere. So that gives them a negative discounted cash flow price per share of $137.46. One thing too I want to add in here on the free cash flow is right here we can see in the trailing 12 months we're positive $2.8 billion on free cash flow. So their cash flows might be stabilizing going forward, but it's just something to keep an eye on. Rule 72 over here, we have 3 different growth rates from 3 different sources. We average those 3 sources and gives us an average of 16.9 for EPS growth rate. 16.9 goes into 72. 72 goes into 72 4.26 times. 4.26 goes into 10 years. 2.35 times. So what we're going to do is we're going to double our current EPS once and then twice. Could do it 0.3 times, but I just left it at 135 for a future EPS, which gives us a fair value of $1,140 with a 30% margin safety of just shy of $800. Here we go. Finally, we are at our summary of all of our valuations we just did. So we take the average of our 5 methods that gives us an actual dollar amount, and it gives us a fair market value on this company of $555.33, 30% margin of safety of $388.73. Currently trading at our margin, or at our 30% margin of safety. One thing to note, always something just that I add in there a little bit, is to see Anna's price target on this company is $450 per share. So currently the valuation that we got is $100 higher. That doesn't mean we're wrong. That doesn't mean they're wrong. that's the numbers that we each got. So I always trust my numbers. My numbers aren't always 100% correct, but I know where my numbers came from. But it is also up to you guys to do the other half of the fundamentals and look at the news and look at the future outlook of this company. Based on fundamentals, based on what I saw, it's a little not as great as Caterpillar. It's got a few things that I would say concern me a little bit, such as the free cash flow, the increase in debt, their capital expenditures are starting to uptick. You know, you just I wouldn't say it's bad, but it's just something to really watch, going forward. That doesn't mean that this company's not worth $555. I think it's pretty decent. I think it's a pretty good company based on our calculators. They all are telling us that it's in that range. That I would say, you just looking at the numbers in general, if I was to put a price tag on this company, I would say it's about 500 bucks, looking at it. So, sometimes you take out that one, you take out that one, then you average these other four and you're like, yeah, I'd say it's about 500-ish dollars there per share. So, all right, so we're over here at the stock chart on John Deere. Really in middle of 2020, this company just took off. And since then, as it just kind of stayed relatively consistent. It hit its high, broke it, pulled back, broke its low, broke its high. I'd say it's a double top, triple top, really, if you look at it. And then is making higher lows so far. So could be making a little bit of a wedge pattern right here at the 446 range here. We draw that line in somewhere in this range, I would say, is a kind of creating this shorter term wedge in this company, which could lead to a future breakout and push this company close to our price target. Currently, I mean, I like the pattern. I think actually this is a this is probably a pretty good area to pick up some shares and maybe run John Deere up to hopefully maybe it breaks through this. Maybe it comes back up, could pull back again and break through and finally head higher towards maybe closer to $500 a share. I think this is a good trade. Honestly, this one, at least you take this right here at about 384, probably put your stop. I think a good stop would be about 350, about a 34 to $35 stop loss on this company. If that's how you wanted to trade it, you could put a stop loss way down here as well, but your risk to reward is actually, cut in half, but still pretty good risk to reward. It'd still be about a 2 to 1 risk to reward because you're looking at about $500 per share and then you'd taken about a $60 loss. So I mean, yeah, it's still 2 to 1 there, but you could also get it down to like a 4 to 1 if you put it right around here. So I don't know. It's up to you guys, obviously, but that's something that I'm gonna look deeper into as well. And I like Caterpillar and I like John Deere both. If I had to pick a favorite, I think I'm gonna pick DE because I think it is a little more undervalued and I think it's got more upward potential than what Caterpillar does. I think Caterpillar has already got all of its priced at fair market value, whereas John Deere currently is undervalued. So even if we wrote it back up to where analysts had an expectation of $450 per share, that's still uh, a good dollar made on this company. If this video helped you in your decision making, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.